Hello everyone and welcome to another stock analysis video. Today we will go over Meta Platforms, which is also known as Facebook. But before we start, let me remind you that this video is not a financial advice and it is for entertainment purposes only. This company is a social media company that generates its revenue from running ads to the users. This is the last annual report filed with the SEC. The company has two classes of shares: Common Stock Class A and Common Stock Class B. The shares available to us in the stock market are Class A. Class B shares are owned by the CEO and other few people to control the company because each Class B share has 10 votes, while Class A share has only 1 vote. This company owns Facebook, Instagram, Messenger, and WhatsApp app, and recently, the company is investing in the augmented and virtual reality products. Unfortunately, and as you can see here, the company is clearly saying that they have no intention to distribute dividends because they want to reinvest all of the earnings back in the business. But just in the last quarter, the company bought back 58 million shares, and in all of 2021, they bought back 96 million shares, which reduced the outstanding shares by 4%. Which is a massive move to increase the value of the stock. Also, the report is showing that the company will continue to buy back their shares. The annual report shows this graph of the stock performance in the last 5 years, and basically, it is showing that a $100 investment in 2016 now is worth about $300. The income statement shows very strong revenue growth in the past 3 years, which is an amazing growth in my opinion. The balance sheet surprised me because it shows no debt. This actually blows my mind because it is the first publicly traded company that I see without any debt. Of course, it's a very good news because we don't have to worry about bankruptcy from defaulting on their loans since they don't have any interest to pay. The cash flow statement shows a very strong operating cash flow, which is essential for any company to stay in business. The thing I don't like about this report is how much the company is spending compared to the revenue for the augmented and virtual reality business. The company spent $12 billion to get in revenue only $2 billion. I think this is crazy, but it seems that they want to be the first in the market to establish this new area of business. Hopefully, it pays off in the future. I'm recording this video in July and we know that the stock price lost almost half of its value. In my opinion, there are two reasons for this loss of value. The first reason is that in the last quarter, the daily active users fell by a very small number, as you can see here. But this is not a concern for me because in the first quarter of 2022, the daily active users exceeded that number. If daily active users would have fallen again, then that would scare everyone because without users to show them ads, the company lost its value. The second reason that caused the stock to go down in value is the state of economy in general. Everyone is expecting a recession, which causes businesses to spend less on ads, which leads Meta Platforms' revenue to go down. But I'm also not worried because in the first quarter of 2022, the revenue and operating cash flow is stronger comparing to the first quarter of 2021. Now let's jump to the intrinsic valuation. I analyzed this year's annual report and a couple of previous ones, and in my opinion, there are 4 keys to find the intrinsic value of the stock, and they are the daily active users, the free cash flow per user, outstanding shares for Class A, and return on investment. So I made 3 scenarios, and across all 3 scenarios, the outstanding shares is the same, and I assume the company will buy back 2% of its shares. I also assume that the return on investment is 10%. This could be high, but social media companies are riskier than, let's say, a manufacturing or a utility company because this field of business is always changing and there is always a danger that users would stop using Facebook and move on to another platform. So the first scenario is the worst case scenario. And I assume that there is no growth in the daily active users and the free cash flow per user is down by 10% from what we have in 2021. As we can see here, After 5% discount to convert the earnings to present value, the intrinsic value of the stock is $147.27. The second scenario is basically the same performance as 2021, and the present value of the intrinsic value of the stock is $164.47. The last one is the best case scenario, which assumes that the daily active users will grow by 20 million users every quarter, and the free cash flow per user is 10% more than the 2021 level. So after 5% discount to convert the earnings to present value, it would give us an intrinsic value of $181.84. Thank you for watching this video to the end, and please let me know in the comment section what stock you want me to analyze. Also, don't forget to subscribe and like this video.